Today's last paper is, does private equity ownership make firms cleaner? Evidence from the sky. So we're sort of moving from hedge funds to private equity among the different titans of industry. And at a very early time in what's it called, mountain time, Karl is going to be the discussant in a little bit. So thank you for being up very early. At least it looks like maybe the sun is up. And the presenter,
it's now rising. I don't want to show the beautiful mountain backdrop. That would make people think of other things they'd like to do on a Friday.
It's about to set in Stockholm. And the presenter is Aymeric Bellon from Wharton. The floor is yours.
Good morning, everyone. I'm a PhD student in finance at Wharton. I would like first to thank the organizer for having my paper in this session. The more I work on this paper, I realize that the role of environmental liability risk is very important. And then I changed the title. So the new title is, does private equity ownership make firms cleaner? The role of environmental liability risk. Let me start this presentation with a motivating fact. There is a reptile that lives in the Texas desert where a firm was about to build a sand mine. This company did everything possible to make sure as few lizards were harmed during the production process. And it happens that this firm is owned by a PE-backed firm. And this is surprising that such a firm behave in such a way, because the way we usually think about private equity firms is different from an owner that care about the well-being of reptile. They are often portrayed as owners that will use financial engineering to extract as much value as possible from their portfolio companies, even if this harm other stakeholders. Elizabeth Warren does not hesitate to compare them as vampire, the idea being that they will buy a company, extract all the wealth from it, and then this will kill it. Therefore, today's research question is, do private equity firms create shareholder value at the expense of society? So this is an old question in corporate finance. People have studied this question through the lens of consumers, governments, and workers. So for instance, people have looked whether private equity firms increase prices, thus harming the well-being of consumers, or change the way firms pay taxes, thus harming governments, or change the wage of the worker or reduce employment, thus harming workers' welfare. But there is a missing stakeholder in this literature, namely the people incurring the cost of toxic pollution. And this is an academic gap, and the goal of today's research will be to fill this gap. Also, maybe more than a yes or no answer, we are interested in the economic mechanism, the friction that is driving the effect, and how can we relate this effect to economic models that we know. Why do we care about pollution in the private equity sphere? So from the last 10 years, at least in the US, private equity firms have invested heavily in industries that generate a significant amount of waste, 30 to 40% of the acquisitions according to Preqin. And this includes the natural resource industry, the energy, the heavy industry, and the infrastructure sectors. Also, pollution matters because in the short run, it has effects on public health, worker productivity, housing prices, but also in the long run, it is an important contributor of climate change. Part of the reason why no one has studied this question before is that it is difficult to do so. It is difficult because we need to answer two main challenges. The first one is to find microdata on pollution and its intensity. And private equity firms, they usually target private firms and small and new firms. And basically these firms, they are not available for all the previous databases that have been used in the previous literature. Like for instance, the data that we use in the previous great paper from Ian, TRI has a report threshold that don't cover small firms that PE firms will usually target. The second challenge is an industry problem. Unfortunately for us, we don't have a counterfactual and we cannot observe the same firm without PE ownership. So the way I handle the challenges today is by focusing on one industry. I restrict my analysis in the oil and gas industry. Why does this help me to do so? Because by focusing on this industry, I collect new administrative data on chemicals that oil and gas firm when they frack a well. So I have my unit of observation will be at the project level. Secondly, a particular feature of this industry is when a firm pollutes, it emits flames. And there have been some recent advances in physics and remote sensing that provide us some tool that we can use to recover this flame from the sky. Therefore, with these two databases, I have a unique and novel picture of corporate environmental policies on 2 high-frequency project-level datasets. And the good thing with the SKY data is that it is reporting free. I mean, reporting bias free. People, they don't time the cloud on the sky to just like avoid polluting. To handle the second problem, the endogeneity of PE deals, I adopt and validate a nearest neighbor research design. So my assumption, my identifying assumption in this analysis will be to say that if you have a project that is owned by a PE-backed firm, if you take the closest neighbor, then this can be used as a valid counterfactual. Although this is a strong assumption, I provide several pieces of evidence that indirectly support it. For instance, before the acquisition, I show that characteristics are balanced when you restrict at this level of comparison. Then I use the richness of this setting by using a novel natural experiment and an undocumented class of PE contracts to better understand the economic channel that is driving the effect I observe in my data. Also, what we gain in terms of internal validity by focusing on one industry is not really done at the expense of external validity. Why? Because when you look in terms of funding attractivity, the oil and gas is the second sector in the US for the last 10 years. Moreover, we are talking about more than 55 million households that live in a shale basin as of today. 30% of methane emissions come from the oil and gas industry in the US, and the methane is 80 times more potent than CO2 and is one of the main contributors of CO2. My findings are the following. PE ownership causes a drop in pollution. This drop is statistically significant and economically meaningful. I observe a drop of 70%. I observe a drop that is equivalent to 70% in the baseline level for toxic pollutants. And for my measure of using satellite data, it is equivalent to half of the baseline rate of flaring. Why do I observe such a drop in pollution? This is consistent with 2 economic theories. The first one is that PE firms reduce agency friction between shareholder and managers, and I observe a reduction in pollution when it maximizes long-term shareholder value. The second channel comes from the fact that if you want to sell a polluted assets in the private market, this is extremely difficult. Why? Because polluted assets are traded for negative discount. And this is a fact I document. And the reason why is because if you buy a new polluted asset, you will be exposed to more environmental liability risk. For instance, you will be exposed to environmental, to cleanup costs by the US Superfund. You will be exposed to environmental torts, litigation, future compliance costs. People, they don't observe this risk perfectly. They have heterogeneous information set. They have heterogeneous beliefs about the distribution of this risk. Then they have different, at the end of the day, they have different valuation for the same asset with different level of pollution. There are different willingness to pay. So this will create heterogeneous demand and when you have heterogeneous demand, we know from IO 101 that you as a producer have an incentive to change the product. So in our case, the producer is a PE firm. The PE firm has an incentive to make the portfolio company cleaner for 2 main reasons, and I won't be able to disentangle the 2 reasons. The first one is by making the asset cleaner, you attract more buyers. Then when you have more buyers in equilibrium, your selling price is higher. And the other channel is by having a cleaner asset, you can either sell the asset at a higher price, because now you are able to attract buyers with a higher valuation. I apologize if you're already very familiar with the oil and gas industry. Let me provide you some basic background so that we are all in the same level. The way an oil and gas firm work is very simple. They just need to find a piece of land and then drill a well. In doing so, they have 2 main different ways of polluting. The first one is by extracting the oil and gas trapped into the rock. They need to inject high pressure water mixed with toxic components to create some cracks into the rock so that they can extract the resource. And this is the first way of polluting. The second way is by burning the gas that is extracted from the well. Why do these firms burn the gas that is extracted from the well? Because in this industry, oil and gas are often co-product, which means that when you're just interested in the oil, you will have to extract some gas. And if you're just interested in the oil and you extract some gas, most of the time, if you're not interested in it, you will burn it. And this is a huge amount of pollution in the oil and gas industry. Let me summarize 1 year of work in 1 minute. I collect new administrative database that I merge to commercial data in this sector. where I observe at the project level, the way I will define my toxic component will be by using congressional reports. This definition of toxicity is interesting for two main reasons. The first one is that these components are exempt since the 2005 Energy Act from federal regulation, which means that and this exemption is highly controversial. So I observe a way of polluting that is legal, yet controversial and exposed to environmental harm. And the second reason why I use this list of toxic components is they are supported by local anecdotal evidence of contamination. So we know that when oil and gas firms use, for instance, lead into their fracking, this can pollute the surrounding water, thus creating some clear damage to local people. Then my second measure of pollution is based on the fact that when oil and gas firms pollute, you can observe it from the sky. And then, you know, using some physics formula, the Max Planck equation, for instance, you can record it from the sky. And this is my second measure of pollution, whether they produce CO2 and burn this gas. At the end of the day, I have a sample of 130,000 projects that started between 2010 and 2019. In this graph, you can see the geographical distributions of the project I have in my sample. To put a dollar value on the project I have, this is equivalent to $100 billion project. On average, one firm in my sample will have 100 projects, and the average rate of pollution is a bit more than one project out of 4 will pollute, and one project out of 5 will flare the well. At the end of the day, I have 106 PA deals. The way I use the PA deal comes from 3 sources: PitchBook, Preqin, and another data vendor I found specialized in the oil and gas industry. These deals have a transfer of ownership, that these deals are made by 55 PE firms. And then I observed 50 DRILCO contracts. What are DRILCO contracts? This is the second important component of my empirical design. A DRILCO contract is a type of contract that PE firms use in the oil and gas industry that is very particular to this industry. It's when a PE firm will just provide financing without any change in control rights. So basically, a PE firm will buy some working interest in a trench of wells without really looking at how the management do the drilling. And you have a citation from Tim Murray from Benefit Street Partners that say, we don't micromanage operational details about how you're fracking the wells in a DRILCO. This will be interesting to understand a bit more the channel that drive the effect. So armed with this new database, let's look at the net impact of PE ownership on pollution. We cannot regress my measure of pollution on PE ownership. Why? Because of an indigeneity problem. And this comes from the fact that in the oil and gas industry, PE firms will acquire their target companies when the firm will reach some major milestones in their development, such as an expansion. So when a firm is about to expand, most of the time it will receive some PE funding, and then the expansion can correlate with variables that will change my marginal cost and benefit of polluting. So let's take an example to really understand the indigeneity problem. Here you have firm 1 that is drilling in location L. At time 1, it happens that in location L, the porosity of the rock is low, so there is no need to use a lot of toxic components. At time 2, the firm is drilling in location L, that is a different type of rock with a high degree of porosity. Between time 1 and time 2, the firm wants to expand its production, so sell some shares to a PE firms. So if you just do a before-after comparison, you would just observe an increase in pollution. But this increase would just be driven by the fact that now the firm is drilling in a different type of rock. So the project that the firm has used changed. Now we are not comparing apple to apple. So this is an important indigeneity problem. And the way I suggest to solve it is by saying that you can use the closest neighbor, as you can see in this graph, as valid counterfactual. Why does it make sense to use the closest neighbor in this setting as counterfactual? Because most of the heterogeneity in the marginal cost and benefit of polluting in this sector will come from the land. Basically, the type of rock will be the same for 2 projects that are close to each other. Moreover, the local population that drive the marginal cost of polluting, for instance, if there is a city close to my well, will be the same for 2 wells that are close to each other. Moreover, the local supply of chemicals. Most of the time, firms buy from suppliers that are in the same region. This will be the same for 2 firms that are close to each other. Finally, public infrastructure, for instance, pipeline, that is the major cost when you want to connect your well to a pipeline to avoid flaring comes from the proximity to pipeline. Similarly, for two firms that are close to each other, this cost will be the same. And I showed that before the acquisition, when you just look at when you compare the firm that will be acquired by PE firm and the other, the closest neighbor, I showed that there is a balanced sample between the two, which provide me some indirect evidence that this identifying assumption makes sense. So how do I translate this identifying assumption into a regression framework? So I regress my measure of pollution, Y, that is defined at the P project level for firm A that drill in location J at time T on a firm fixed effect, plus a year fixed effect interacted with my location measures. This is a simple way to put the level of comparison at the project level. Then I estimate an event windows around the deal. And finally, I add very detailed controls at the project level, such as the size of the well, the horizontal and vertical size, the production of gas and oil. And then so this is the main result. In the x-axis, you have the semester around the deal. In the y-axis, you have the gamma tau that is estimated above. For instance, here, with what this coefficient is telling me, this is telling me the difference between a non-PE-backed firm and its closest PE-backed firm neighborhood 4 semesters after the deal, when you control for all observables. As you can see before the acquisition, I don't have any pre-trade. Then you see a drop in pollution that is increasing with time. The reduction is jointly statistically significant and is economically meaningful. We are talking about a reduction equivalent to 70% in the baseline number of toxic components. Then I use my satellite data that is a bit more noisier, as I show in the paper, because you have the cloud, and when you have a cloud, you cannot really observe it from the sky. With this concern in mind, however, you still find a reduction that is increasing with time and that is statistically significant and economically meaningful, equivalent to half of the baseline rate in flaring for my sample. However, when you change the type of deals and when we focus on PE contracts that imply just financing, but no change in control rights, so when the PE firm has no ability to control the management team, I don't find any effect. And this absence of evidence is highly robust. So although we can still explain this result with a lot of, although these 3 results can help us to close some explanations, there are still a large set of explanations that are consistent with this result. So to understand a bit more the channels, I will use a natural experiment in this section. So the Bureau of Land Management is responsible for environmental regulation in Native American reservation and federal land. And what is interesting for us is these boundaries have been decided at the end of the 19th century or the beginning of the 20th century, and are thus orthogonal to shale basins that have been discovered only at the beginning of the 21st century. So the basic idea I will do is a triple difference in differences and exploiting some shocks that come in this ability of this federal regulation to regulate fracking. More specifically, between 2012 and 2015, the BLM was drafting a rule to regulate fracking in these areas. However, in 2015, you have a preliminary injunction that is filed to challenge this fracking rule. Then the rule will be abrogated by the District of Wyoming. And then after that, the Trump administration is inaugurated and decided that BLM should not be able to regulate fracking. And basically all these legal texts use the fact that as fracking is exempt from a federal regulation, as the BLM purpose is referred to this federal regulation, then BLM is not allowed to regulate fracking. After 2018, however, a state of California and a group of environmental activists sue the BLM for voiding the fracking rule. So I have basically a period where the ability of BLM to regulate fracking was extremely low because of this court ruling and the change in the Trump administration. So the way I explore these shocks is by running a triple difference in differences. I will not go over the whole equation, but to provide you some intuition, I take the difference in pollution between regulated and non-regulated areas for projects that are close to each other, so at the boundaries, okay? So you see it's like a RDD. I take the projects that are in a Native American reservation and the closest neighbor, they have built drilling at the same time. And I take this difference, you can think of a spread, I take this spread for both PE-backed firm and non-PE-backed firm. And this difference, I will take it after I purge out of all firm level characteristics, and I include a firm year fixed effect to include any change that happens at the firm level. So the results are the following. As you can see here, the spread between regulated and non-regulated area for PE-backed firm relative to non-PE-backed firm increases when regulatory risk is lower. So basically you have more relative pollution in areas where regulatory risk is lower for PE-backed firms. So the effect I observe is a function of regulatory risk. This is extremely precious for me because it allows me to better understand the theories that drive this effect. This helps me to reject theories based on non-pecuniary motivation. Because if PE firms want to make the world a better place, then this effect shouldn't correlate with regulatory risk and the ability of a federal agency to regulate fracking in Native American reservation. Also, this shock helps me to better to rule out an explanation fully driven by technological change, because there are no reasons that this shock I observe will correlate with technological progress. So first, I observe it very well because I observe the size, the type of technology that project use, so I control for that. But if you don't really believe in my controls, this shock basically helped me to reject an effect fully driven by technical change, because there is no reason why this shock will correlate with technological change. Then in the paper, I spent a lot of time trying to better understand the channel driving the effect. I ran many tests. The first one is consistent with an investment horizon channel. So basically, there is asymmetric information between managers and the owner of the firm. Then managers have an incentive to signal their type, so they will take inefficient actions if no situation is polluting. And I found that PE firms basically align better incentive between managers and shareholders, and therefore this allows for long-term wealth creation. And I show it basically by looking at public listing. So when I replicate the analysis you showed before, after and before an IPO, you show that pollution increases, and firms that are close to miss their earning targets start increasing more. So basically, this shows me that in my control group, I have public listing associated with more pollution. Also, a nice thing that is interesting with this setting is I can observe the cash flow for flaring. So I collect new data from the North Dakota Environmental Department, where basically they collect all the flaring cash flows. And what I show is you need to be a long-term investor. You need to value a lot long-term cash flows if you want to reduce flaring. Why? Because if you want to connect your well to a pipeline, you need to pay several millions at the beginning of the project, and then it will only pay off 5 to 10 years after the project is drilled. So if you have short-term incentive, you will not connect your well to a pipeline. And then the second channel I find is that PE firms reduce pollution to increase the exit value. And the reason why is because polluted assets in the M&A and assets to asset market is penalized assets that are polluted. If you want to sell a polluted asset, you will have to sell it at a lower price. Although I lack quasi-natural experimentation to show this fact, I rely on the new data sets and I observe a very high degree of controls. For instance, I can observe the acreage or the potential value. These variables are variables that practitioners use when they decide to purchase a project. So although I don't, and what I do is I include these controls step by step. So I first show the raw relationship, and then I include the control step by step. And you see that the negative discount is very persistent. And finally, I include a seller and a buyer fixed effect. So when the same seller and the same buyer sell assets, you can see that assets that are polluted are traded with a negative discount. So although it's a result I think we should be cautious to look at, because I don't have way to validate the identifying assumption I put. I think this is strong suggestive evidence that if you want to sell a polluted asset, this would be done with a negative discount. So basically, you as an owner, as a PE firm, if you want to maximize your exit value, you know that if you sell a polluted asset, you will sell it at a lower price. So PE firms are value maximizing firm. They want to maximize their exit value. So as we know from IO 101, if by selling a polluted asset, you will sell it at a lower price, you have an incentive to make it cleaner, either by increasing more buyers, or by making it cleaner, you can sell it at a higher price to attract the buyers that value a lot cleaner assets. And I show in the paper that the interaction of these two effects explain why the decrease in pollution is increasing with time. Because the more you hold the asset, the more likely is the PE firm to exit. And when you're close to exit, you really want to make your asset cleaner as possible to maximize the exit value, which is why I observe a decrease of pollution with time. So let me conclude. I found that PE control leads to a reduction in pollution that is economically and statistically significant. It is driven by pecuniary motives from a long-term investor. And I think one implication that is relevant for practitioners is that we have seen recently a huge initiative to decarbonize portfolio, especially from the oil and gas industry. And one implication of my paper is that be careful, this can basically backfire, because if for instance, in my sample, you change the corporate governance of firm in the oil and gas industry, then this could create an incentive for these firms to pollute more. So to come back with this initiative, people say usually that we want to stop investing in the oil and gas industry. Why? Because in doing so, we will increase the cost of capital. By making the cost of capital, we reduce production. But what my paper shows is that if you also change the corporate governance of this sector can start producing, but by polluting much more. And given the magnitude of pollution that this sector is responsible for, then I think we should be cautious about this initiative to decarbonize portfolios. Thank you very much for your attention, and it's still a work in progress. So if you have any question, please feel free to reach me.
Perfect. Thank you. The discussant is Karl Lins. We have around 10 minutes. There's a lot of questions. So Aymeric, you can look at the Q&A if you want. Otherwise, I will pick a few. Once you're done responding to Karl, I will pick a few and read the questions. All right, Karl.
Go. I needed to get permission to share screen, and I think I've got it now. Let's see if it's getting. Are you guys getting? I didn't have a chance to test it because I had to come on midstream. Are you getting my screen as the entire thing? So
try to hit F5.
Let's getting it now.
Yep.
Awesome. All right. So let me. First of all, thank Bo and the other organizers for allowing me the chance to discuss. It's fun to see a very data-intensive paper. So Aymeric, when you said you spent a year processing data, I think I heard that. I'm sympathetic as a PhD student. It's kind of high risk, and hopefully this will be high return for you as well in matching it together. And mainly the comments I'm going to have, I think that you did a good job presenting it, is just going to be ways to try to frame it better, I think, especially totality of what you have, especially as you add new tests and you want to have kind of a coherent theme based on the kind of preponderance of evidence. So that's what my comments will be mainly about. And at the very end, I've got a few that are just specific to writing that I probably won't read out, to everybody, because, after 4 presentations, you don't want to read something about appendix table A10 that might be, better presented in a different way. So that's where we'll go. So here we go. So the main thing I had as kind of a complicating factor in my understanding of the paper was to try to get at the takeaways. There seem to be different takeaways, and the consistent theme, like if you want to look at the headline of the abstract or what you would do somebody in a 20-second elevator pitch, is that private equity ownership leads to less pollution. And then there's several channels on my slide, but one thing that I was hoping to see is kind of a linkage to the increasing work on large-scale institutional owners wanting to reduce pollution, just because it's, they expect to hold assets in the long run, whether they sell them or not is kind of an independent choice, and they need to be less polluting in order to get that kind of an exit, or just to be more valuable in the long run. So I'm kind of excited about that, but then I quickly see that when a private equity firm now doesn't have to, or maybe doesn't have to, stop its pollution of groundwater potentially by using heavy chemicals or polluting chemicals in the fracking process, then they don't. So this is where the rule is kind of relaxed, or at least it's seen like it might go away in 2012, 13, 14, 15. I can't remember the exact timing. Now it's not that PE is doing less pollution. It's just that PE is doing more pollution when it can get away with it, which is just different. So it's like it's hard to have the the takeaway being PE pollutes less when in fact, as soon as they're able to not worry about pollution, they pollute more. So try to frame that maybe a little bit different, that PE responds to different types of incentives depending on, you know, that. And then the other thing that is kind of tricky about this, I think I have it on a later slide, is if private equity is really looking at a long run exit, we're talking about maybe 3, 4, 5, 6, 7 years from the time you'd actually do the drilling for some of the wells. They're probably expecting regulations to change. So something maybe a little spurious with this idea that, or with the data where you find on the Native American reservations or the federal land that the pollution goes up for a little bit and then it goes back down when there's a little more possible challenge by California's environmental activists. Almost everyone in the oil and gas industry the last 20 years would know that regulations are likely to change where fracking is going to be more regulated. So I just don't think they would like, oh, we can get away with it. Oh, now we can't. So maybe check for robustness on that. And then what I really wanted to have fleshed out and almost like draw a diagram mentally is this idea, and I think it's great. You have 2 independent sources of pollution data, but try to describe what the decision process is on how much to spend, so to speak, on pollution abatement. The first is a decision on whether to use toxic chemicals in the fracking process. That's a year 0 choice, and you're stuck with it from now on. You go in there and you prop things up with the sand proppants, and you stick a bunch of other things in there that are going to more deeply penetrate, and then some of it comes back more polluted because you chose 6 relatively polluting chemicals, and then the groundwater is that's stuck. You got to deal with it. And now everybody's going to say, whoa, that set of wells has the potential for groundwater contamination. Whereas flaring is essentially you're producing the whole time, some oil, some gas, well, some gas if it's flaring, otherwise there's no flaring. And if you start to get regulations or you start to say, wow, we want to sell this entire field or this whole package of fields in the Permian Basin, let's spend the money to hook up to a pipeline. And now we can say we are not a flaring company. So you can kind of defer the expense. And I think that would possibly give you different ways to tease out, you know, the severity of pollution that private equity will tolerate. So just maybe make that more of an integrated part of your paper. And then I liked it, and I think you did a great job trying to do the best you can, but the piece on it towards the end about looking at sort of like the public versus private pollution incentives, I unfortunately think it's kind of too narrow to be usable. And the reason is you have 7 IPOs, and that doesn't necessarily mean that's reflective of all publicly owned oil and gas companies' incentives for pollution abatement. And so, you know, IPOs are often an exit for an owner. And I looked a little more carefully at what this is, and I saw Kinder Morgan, and I thought, oh my gosh, okay, this is going to be a problem. So are any of these IPOs that are exits between 2011 and 19 affiliated with private equity? And the answer is huge and yes, because Kinder Morgan, private equity in 2006, and then they went on in 2011 to basically go public, and then they did a bunch of roll-ups of all kinds of other, you know, acquisitions of existing medium-sized, and it would sit there and have the contract term ability to say, oh, we just bought you and now stop using a bunch of fracking chemicals that are polluting. It's like a huge company with a whole bunch of moving parts, and then 6 other smaller IPOs that are all put together kind of in one model. So maybe do it as a case study and really dig into what Kinder Morgan did, but I don't know that we can do much else with that. And then also just, there is a lot of evidence, especially, so maybe that's why Bo picked me as a discussant, but after the BP Deepwater Horizon event, institutional investors from everywhere, all around the world, and especially pension plans and just general institutional investors that had shares in publicly traded oil and gas companies around the world, they pretty much forced these companies to improve their environmental performance. So this is, you know, 10 years ago, it's been known for publicly traded firms that they've got to improve oil and gas environmental performance. So that maybe can be something you can use to link in with the incentives to pollute or not. And then the final thing that I was going to have here on just advice is this. It's written up as though there's going to be a lot of tests when you say that private equity wants to maximize exit value, and let's look at some transactions where that happens with an independent database, which is nice. But by the time you really get down to the usable transactions where you're kind of controlling for buyer and seller and as well characteristics, there's not a significant result. And what I believe might be going on here is it's just the reasons that oil and gas wells or acreages are bought or sold are just so variable. It's just really going to be hard to find pollution as one piece. You have operational efficiency, adjoining acreage. One operator's got a financial constraint and they were using something cheap, and now you're able to do it systematically. There's a whole lot of things that go on, I think. And what you probably have in mind is a private equity firm that comes in and says, we're going to put in best practices, including using the right type of sand proppants and the right type of chemicals, and roll it out to all of our wells that are there. But I think all the transactions are just too muddy. That just doesn't happen that often. It's just going to be a bunch of piecemeal transactions, kind of like real estate deals in different neighborhoods. There's really no one way to summarize that. So
2 minutes.
Thank you, Bo. And so one thing I was going to suggest, and it struck me, in fact, let me back it up and frame it that way. I don't want to have to read it directly. I like the test of the Native American lands and federal lands all of a sudden being subject to a regulatory shock, and people realizing that, you know, the Trump administration said, hey, we're going to void that rule. I thought 4 years ago about doing a paper on oil and gas pollution and kind of extractive industries pollution, with the even bigger shock in which I think you could use your entire sample of firms, not just, you know, everywhere. So you're getting the West Texas basins and the Pennsylvania and North Dakota. And that is just look at what all the private equity owned oil and gas production did when you had the unexpected kind of natural experiment of Trump being elected. I mean, that was truly unexpected. And it was absolutely known that he would not give a crap about enforcing any extractive industry or, you know, environmental regulations. And now see what PE did in the last 4 years. That seems like a huge test and clean and hopefully a large enough sample. So that's what this slide here is talking about. You know, it was very surprising, the election of Trump, you know, on election day and afterwards, see what happened. Or so the oil and gas private equity firms do more or less polluting post the Trump event. And then the final things here are just, because I've got probably 30 seconds, I'm just going to send you the slides, Aymeric, but just be careful to write and define things, you know, decide what's important for the text. There's way too many footnotes up front. There's a huge introduction. There's a whole bunch of tables. Then there's a big a set of institutional characteristics. Try to put that together in a tight way and try to use words, you know, like negative discounts, kind of confusing and that kind of stuff. So I will exit the screen and I will turn it over to
Aymeric, you can decide how you want to use the last 5 minutes of the day. You can discuss Karl's comments, or if you prefer, I will select questions from the Q&A from the participants. Up to you.
Thank you. So maybe I can give a quick answer to Karl, and maybe we can go through the Q&A. Thank you so much, Karl, for the remarks. I think they make a lot of sense. I think for the Indian Native American reservation test, I have like a firm year fixed effect. So the effect I'm recovering is like, you know, like it's a spread between non-regulated and regulated areas. So maybe, you know, they drop pollution overall, but they drop it less for Native American reservation. And I think I would spend any more time to make it clear in the text, you know, that what I remember, like it was maybe not written as it should be. So maybe I will spend more time, you know, writing it and saying, this is really a relative pollution effect. So you can reduce pollution overall, but reduce it a bit less in Native American reservation because you know that the marginal cost is lower. And I totally agree with you, you know, about the buyer-seller thing, you know. there are so many things that happen when you want to sell a tranche of wealth or a piece of wealth. I totally agree. And I think this is why I have a high standard error. Even when I add all the controls, you can see that the standard error I have in the effect is extremely large. And I think this is consistent with this idea that even if I have an economic impact by the coefficient, like the point estimate is significantly large. However, I have a large variation, a large standard error. And I think this is coming from the fact that, as you were saying, there are so many things, so many different variables that come into place when you want to buy a piece of land. And I think, in some places, they really don't care about pollution. Maybe they care it more if you had like an environmental lawsuit in the neighborhood. There are so many things that can happen. But the thing that I found with this database, I still found this negative correlation. Even when I add controls over and over, sometimes they become imprecise and non-significant, but the point estimate is the same. Kind of suggests me that this exit pressure channel is there. And then I think maybe we should talk more about the other point. And thank you so much for the discussion.
Great. We have about a minute or two. Would you like me to read you one or two of the questions in the chat?
Yeah, perfect. Yeah, thanks.
Okay. So here's a question from an anonymous attendee. It says, so is the conclusion that PE representatives follow legislation and societal constraints better than other firms?
I totally agree with this conclusion, actually. It makes a lot of sense. Like a PE firms as super maximizer owner that will take all the piece of information that are out there and to maximize it. So you have this industry that is exempt and is kind of controversial why this industry was exempt from federal regulation. And they know that this will change in the near future. So they start reducing pollution by anticipating this pattern. Well, I totally buy the conclusion, yeah. Thanks.
Okay, perfect. That was my favorite question from the Q&A. And now it is 5 minutes past 5 Swedish time, maybe breakfast time for Karl, and very late for some of our attendants. I want to thank everybody for joining us today. Day 2 of this conference promises to be as exciting and informative. It starts at 2 p.m. Central European time tomorrow. And I look forward to seeing everybody there. Thank you so much for being here today.